I want to start with the S&P hitting record highs. If you come inside the Bloomberg, you can see that we're sort of testing this resistance level that we bumped up against for 2 times already. Do we get a sustained breakout?
I think we probably will, and I say that because earlier this week the market broke out from a flag pattern. The flag pattern is essentially a bullish consolidation phase that marks an interruption in a strong rally and then a little short-term breakout. Those tend to see positive, really immediate follow-through, and that's what I think we saw at the start of yesterday. So today's weakness I don't see as really interruptive in that trend. I do think we'll see a confirmed breakout, whether it's next week or the week after, I'm not sure. And yet that would dictate a bullish long-term bias in addition to already the bullish short-term bias.
So a lot of the talk over the last few days has been how utilities have really, in some ways, outperformed. So when you take that lens and look at it through a growth versus value portfolio, if you come inside David's terminal, you can see how growth has really broken out. Do you expect then growth to be leading the overall S&P breakout?
I do think so. We've really seen these breakouts work, and of course this one in favor of growth, and it's happening on both the small cap and the large cap front. So I think we can expect continued outperformance, growth over value. Obviously the utilities and the like are able to outperform in an environment where yields are downtrending, and yet I think that trend may actually lose its downside pace. So we do have some signs of downside exhaustion, at least in a short term, on the 10-year Treasury yield. It doesn't mean it will avoid a breakdown below that 2% level, which is very key from a technical standpoint, as you could imagine. And yet I think we'll see a loss of downside momentum there at least.
Yeah, let's get to that, because if we have a chart that kind of shows that, how we broke below, if you come inside the terminal, the 2%, and we've tested it, right? Like we've dipped below and then we've always come back up. What would you look for technically that would see that there would be some more downside follow through for the 10-year?
It is important to differentiate between a test and a breakout or breakdown. By testing, it means you're flirting with a level, a support or resistance level, but you haven't really posted a couple of closes below it or above it. So that's what we're seeing both in the S&P 500 as it tests resistance and in 10-year Treasury yields as they test support. Neither have a confirmed breakout or breakdown. What we would require for that in our work is a couple of weeks or Friday closes below a certain level for 10-year Treasury yields, and that would be about 2% based not only on the level's psychological significance, but also one of our long-term trend following models that you probably have on the chart there. That breakdown would then put next major support for 10-year Treasury yields around 1.4, going back to the 2012 low, which was tested successfully in 2016.